Merger arbitrage. What these funds are pretty specialized. What they do is they invest in an announced merger or acquisition. They're not speculating that some company may get acquired down the road. They're waiting for the announcement to be made. And what's the most recent announcement? What do we have? We have AT&T is going to buy DirecTV. So a merger fund might be looking into that deal and deciding if they want to participate and invest in that. And so how would they invest in that? If they try to capture the small spread, the small difference between the merger price and the current market price. And if they think that that's worth investing in, there's going to be a small difference there, they would buy the target company, in my example, DirecTV, and short the acquirer stock, AT&T, and that by doing so, you effectively remove the risk of the stock market. So and maybe it's going to take, I don't know what the deal is, maybe it's going to take 3 months for that deal to close. So a merger fund would take this kind of investment, and they don't really care if the market goes up or down during that 3 months. They're just going to make money if the deal actually closes. They'll lose money if the deal falls apart. If the Justice Department says they don't want this deal to go through, the deal may fall apart, and then they would lose money. So obviously the most important driver for merger arbitrage is the completion of the deal. Other things that impact profitability of this strategy is simply the level of merger activity. Okay? So if there's very few mergers being announced, these funds may have trouble finding attractive deals. Because of arbitrage competition, there's other funds doing essentially the same thing they're trying to do, and if there's not much merger activity deals going on, the spreads may become unattractive and just not worth the risk. Interest rates also get involved here because we do have some shorting, and when you short, there's a cost to pay for that borrowing.